Hi, this is Fuad Abasov, a broker with Right at Home Realty, and this is your monthly real estate statistics. Alright, so December 2025 is officially behind us, and today I want to walk you through what actually happened across Toronto and the surrounding GTA real estate market. Not just the headlines, but what the numbers are really telling us. We'll cover detached homes, semis, townhomes, condos, rentals, interest rates, and what's driving buyer and seller behavior right now. Most importantly, I will break down months of inventory across different parts of Toronto and nearby areas, so you can see where inventory is building, where it's still tight, and what that means for pricing and negotiating power as we move into 2026 and beyond. And I want to be very clear right from the start. What we're living through right now is not a sudden crash, and it's also not a temporary slowdown that magically fixes itself in a couple of months. What December confirmed is that the market has gone through a structural reset. Don't forget to subscribe for honest monthly GTA stats without the hype. I keep it transparent so you can make smarter decisions. The way real estate functioned between roughly 2016 and early 2022 no longer applies. Different rules are in place now. Sales are slower as sellers are adjusting, some faster than others, and buyers are cautious. And the market is clearing, but it's clearing slowly through negotiation rather than urgency. That distinction is really important. So let's look at the bigger picture. We'll start with the broad GTA numbers from the Toronto Real Estate Board's December 2025 Market Watch. Total GTA home sales for all of 2025 came in at roughly 62,000 transactions. That's down more than 11% compared to 2024 and puts 2025 among the weakest years for resale activity in over 20 years. December itself continued the same pattern we saw throughout the year. Sales declined again on a year-over-year basis, while active listings increased sharply. In fact, active listings in December were up more than 17% compared to the same time last year. New listings for the full year were also up by roughly 10%. This combination, falling sales and rising inventory, is the defining characteristic of the current market, and this is where a lot of people misunderstand what's happening. Inventory is not rising because sellers are panicking and rushing for the exits. Inventory is rising because homes are taking longer to sell. When sale volumes drop faster than listings, inventory grows almost automatically. That's exactly what we're seeing right now, and this is not a supply shock, it's a demand slowdown driven by hesitation and uncertainty. So let's look at days on the market. Another major change in 2025 was how long homes are taking to sell. Both listings days on the market and total property days on the market increased across the GTA. This tells us that the market is no longer forgiving pricing mistakes. During the boom years, sellers could price aggressively and momentum would often take care of the rest. That environment no longer exists. In today's market, overpriced listings sit. They get reduced or they get terminated and relisted later, much more often at a lower price. Negotiation has quietly returned as the dominant force in the market. A majority of homes across Ontario are now selling below asking price, and the sale-to-list price ratio has dropped into the mid-90% range, among the weakest readings in many years. The average selling price across the GTA declined by just under 5% in 2025, with December prices down a little over 5% year over year. What's important here is not just the magnitude of the decline, but the way it's happening. This has not been a sharp, panic-driven correction. Instead, prices have drifted lower over time. Sellers remain anchored to older comparables, buyers are willing to stretch, and deals only happen once expectations finally meet in the middle. From the 2022 peak, prices across Ontario are down roughly 20–25%, depending on the area and housing type. That adjustment has occurred gradually over several years, which is why it can feel less dramatic, but also more persistent. Detached and semi-detached homes remain the most resilient segment of the market in 2025. Prices in this category declined by roughly 4–5% year over year, which is less severe than other housing types. Sales volumes were lower, but end-user demand is still present. Families continue to look for space, backyards, and long-term neighborhood stability. Supply of 3- and 4-bedroom homes with functional layouts remains limited relative to long-term demand, particularly in established GTA neighborhoods. Well-located freehold homes that are priced correctly are still selling. They're just doing so without bidding wars, without urgency, and often after a period of negotiation. Townhomes saw a deeper correction in 2025 with prices declining in the range of 6 to 7% year over year. This segment is especially sensitive to affordability constraints as it often represents a transitional point between condos and detached homes. Buyers in this category are extremely price conscious. Overpriced townhomes are sitting while those aligned with current market conditions are transacting. Sellers no longer have the luxury of testing ambitious prices and waiting for competition to show up. Condominiums continue to be the weakest segment of the Toronto area housing market. Average condo prices declined by approximately 7% in 2025, with some pockets experiencing even larger drops. Sales are very weak, reflecting a major shift in investor participation. A large portion of today's condo supply consists of smaller one-bedroom and studio units that were purchased during the pre-construction boom when interest rates were near historic lows and price appreciation felt guaranteed. As these projects reach completion, many buyers are now struggling to close. Industry estimates suggest pre-construction failure rates have climbed to more than 20% compared to a normal range of 5 to 10%. That is a massive shift. This does not mean condos are unlivable or obsolete. It means the speculative investment thesis that relied on rapid appreciation and rising rents has broken down. The rental market is undergoing a structural transformation of its own. Canada is currently experiencing an unprecedented wave of purpose-built rental construction. Nearly 180,000 rental units are under construction nationally, with a significant concentration in major urban centers like Toronto. At the same time, population growth has slowed materially due to tighter immigration caps. As a result, rent growth has flattened and in some areas turned negative. Vacancy rates have begun to rise and could approach levels not seen since the early 90s. For renters, this represents a meaningful shift. Choice is improving, negotiating power is returning, and landlords are having to compete again, something we haven't seen in years. The Bank of Canada's overnight rate currently sits at approximately 2.25% after multiple cuts from the 5% peak. Variable mortgage rates are now in the mid-3% range, while fixed rates remain volatile due to bond market uncertainty. Despite this relief, borrowing costs remain significantly higher than what Canadians were accustomed to for most of the past decade. Roughly 60% of mortgage holders renewing in 2025 and 2026 are expected to face higher monthly payments. Rate cuts help, but they do not eliminate risk. Job and income stability and broader economic confidence are far more important drivers of demand right now. An interesting signal came from Toronto City Hall as it prepared its 2026 budget. Despite acknowledging extremely weak home sales, including a 25-year low in activity, the city is budgeting for higher land transfer tax revenue in 2026. Part of that increase comes from higher tax rates on homes selling for more than $3 million. But city officials have also indicated they expect modestly higher transaction volumes overall. At the same time, city staff openly acknowledge how volatile land transfer tax revenue has become, swinging from nearly $1.2 billion during the boom years to significant shortfalls more recently. This volatility reflects an unhealthy market, one driven by speculation rather than stable growth. Even City Hall is planning more cautiously now, relying less on real estate activity to fund operating expenses, and acknowledging that dramatic swings are no longer sustainable. And this really brings us to one of the biggest questions people keep asking me: if prices are lower and interest rates have come down from their peak, why aren't buyers rushing back into the market? The reality is, the answer doesn't sit inside housing anymore. It sits in the broader economy. Employment growth has slowed, unemployment has crept up, and for a lot of households, monthly budgets are still stretched. Food costs are higher, energy costs are higher, and debt payments across the board are heavier than they were just a few years ago. Buying a home isn't just about whether you can afford the payment today, it's about confidence. Confidence that your income will still be there next year and 5 years from now. And right now, a lot of people just don't feel that certainty. So even though affordability has technically improved, that alone hasn't been enough to bring buyers back and forth. Until confidence around jobs and income stability improves, transaction volumes are likely to stay muted. Canadians aged 30 to 34 and 35 to 39 are now the two largest age cohorts in the country. These are prime first-time and second-time homebuyer years. Right behind them are younger Canadians aged 20 to 24, many of whom will initially be looking at condo ownership. In other words, the largest buying age demographic Canada has ever seen is sitting on the sidelines right now. Affordability is still a major constraint, but Korea believes one potential catalyst could be the Bank of Canada signaling that it is done cutting interest rates. Even if rates don't fall dramatically from here, certainty matters. Buyers who have been waiting for the absolute bottom may re-enter simply because the rules feel clear. One of the most important insights from Korea's outlook relates to what's often called the missing middle. Canada simply does not have enough housing types that sit between small condos and expensive detached homes. Townhomes, duplexes, triplexes, and low-rise multiplexes are in short supply. For buyers in their 30s who want enough space to start a family, the options are often either too small or far too expensive. Many buyers are saying, I need something big enough to raise a family in, and it just doesn't exist. Or, if it does exist, it's in a legacy detached market which remains out of reach for many households. This structural shortage limits transaction volume even when demand exists. If the product people want isn't available, they simply don't buy. Another misconception worth addressing is population growth. While Canada's population growth has slowed recently due to policy changes, the country still has roughly 4 million more people today than it did before the pandemic. So demand is still there, but it is no longer overwhelming supply in the way it did during the peak years. Now, let's look at how supply is doing in various pockets of GTA, months of inventory. How does this formula work? We take active listings and divide by monthly sales. How do we look at months of inventory? So 0 to 3 months, it's a seller's market, 3 to 5 months is usually a balanced market, and 5+ months, it's a buyer's market. So Toronto is sitting at 5.7 months of inventory, Vaughan at 5.5 months of inventory, Richmond Hill 7.3 months of inventory, Markham sitting at 5.2 months of inventory, Mississauga at 5.3 months of inventory, Oakville 5.9 months of inventory. As you can see, most of these neighborhoods are in a buyer's market territory as they're all over 5+ months of inventory. Feel free to email me if you're interested in sales analysis of your immediate neighborhood. My info is in the description of this video or at the end. Not everyone expects a smooth rebound. Oxford Economics, for example, forecasts that resale prices in 2026 could still slide lower before hitting a bottom, led by declines in the more expensive Toronto and Vancouver markets. However, they also expect the resale market to break out of the slump by mid-2026, supported by more favorable mortgage rates, improved affordability, reduced trade policy uncertainty, and a gradual return to job growth, assuming a successful renegotiation of the Canada-US-Mexico agreement. So what this means for the GTA specifically? For Toronto and GTA, this suggests a very specific scenario. Condos and entry-level investment properties may continue to face pressure, particularly in the first half of 2026. Freehold homes with functional layouts are likely to remain relatively resilient, and if first-time buyers do begin to move in larger numbers, competition could quietly return in certain price brackets, even if the broader market still feels slow. The key takeaway is this: the floor may be forming, but the recovery, if it comes, will be uneven and selective. And now, let's take a closer look at detached home sales in Toronto and surrounding areas. So we're starting with Toronto. Average detached prices in December were about $1.43 million, down roughly 8.5% year over year. Sales were up about 8%, but new listings were also higher, up roughly 8% year over year. Homes are taking around 38 days to sell. In Vaughan, average detached prices came in around $1.65 million, down about 6% year over year. Sales dropped roughly 17%, while new listings rose by about 11%. Homes are taking roughly 41 days to sell. Richmond Hill, averaging about $1.77 million, down 11% year over year. Sales fell sharply, down over 30%, while new listings increased by roughly 13%. Homes are taking about 47 days to sell. Mississauga detached homes averaged about 1.45 million, down around 1% year over year. Sales were up by 5%, but new listings rose by 29%. Homes are taking roughly 37 days to sell. In Markham, detached homes averaged around 1.60 million, down roughly 3% year over year. Sales were up by 14%, new listings climbed about 6%, and homes took roughly 40 days to sell. King City, average detached prices in December were about 2.59 million, down roughly 13% year over year. Sales were up by 20%, but new listings were also higher by 66% year over year. Homes are taking around 55 days to sell. In Newmarket, average detached prices came in around 1.19 million, down about 2% year over year. Sales rose roughly 3.5%, while inventory rose by about 48%. Homes are taking 48 days to sell. Aurora, averaging about $1.47 million, down 11% year over year. Sales fell down by 11.5%, while inventory remained the same year over year. Homes are taking about 48 days to sell. Bradford, detached homes averaged about $956,000, down around 13% year over year. Sales and inventory remain the same and have not changed year over year. Homes are taking roughly 38 days to sell. In Milton, detached homes averaged around 1.21 million, down roughly 13% year over year. Sales were down 29%, new listings remained the same compared to last December, and homes took roughly 38 days to sell. In Stouffville, average detached prices in December were about $2.06 million, up by roughly 51% year over year. Sales were down by 14%, and inventory was also down by roughly 15% year over year. Homes are taking around 44 days to sell. Average detached prices in Innisfil were about $714,000, down roughly 12% year over year. Sales were down 7%, but new listings were up roughly 24%. Homes are taking around 34 days to sell. In Burlington, average detached prices came in around $1.28 million, down about 9.5% year over year. Sales dropped roughly by 14%, while new listings were down about 3.6%. Homes are taking roughly 46 days to sell. In East Gwillimbury, averaging about $1.19 million, down roughly 13%. Sales were up 5.2%, while new listings increased by almost 35%. Homes are taking about 40 days to sell. In Barrie, detached homes averaged around $752,000, down roughly 7.5%. Sales were down 24%, while inventory was down by 11%. Homes took roughly 48 days to sell. In Oakville, average detached prices in December were about $1.81 million, down by roughly 14% year over year. Sales were up by 1.6%, and inventory was up roughly 6% year over year. Homes are taking around 47 days to sell in Oakville. Higher listings, slower absorption, and longer selling times are exactly why months of inventory keeps rising as we head into 2026. Toronto and Canadian real estate market didn't end 2025 with a bang. It ended quietly, and honestly, that's not a bad thing. Quiet markets are usually where the most important shifts begin. Toronto real estate hasn't collapsed. It's matured, and demand hasn't disappeared. It's just been delayed. The supply issues everyone talks about haven't been solved, but they have been exposed. And the next phase of this market isn't going to be driven by speculation or hype. It's going to be driven by real people, real demographics, income stability, and much more realistic pricing as expectations have reset, leverage has shifted, and the market is now clearing on new terms. Decisions being made in this environment, whether you're buying, selling, investing, or choosing to wait, will matter far more than decisions made during the boom years. This is no longer a fear of missing out of market. It's a think it through market. People are taking their time asking better questions and making decisions more carefully, which is much healthier. That's why understanding what's really happening both locally here in Toronto and across Canada is so important. Data gives you clarity, but conversation gives you context, and that's why I am here. So if you have questions, if you're trying to figure out where you fit into this market, or if you just want to talk through options, reach out. I'm always happy to chat about real estate. No pressure, no hype, just real conversations and honest advice.
If you'd like to receive your own personalized sales report about home sales in your neighborhood, please call me at 647-801-3401 or email me at sold@fuadhomes.com. Thanks for watching and see you next month.